This is David Locher from bngloans.com, and today I put together a quick training about unsecured business loans in which we will discuss the current market for unsecured business loans, talk about some of the things that you need to look out for, and we're going to discuss the ideal scenario for funding your business and how to actually get there. So first things first, we're going to talk about the market. This is a quick summary about unsecured business loans, and these loans are not backed by collateral, such as business assets or commercial real estate, accounts receivable, or business's inventory. And they're very common for startups, business expansion, any business cash flow issues that you may have, or even for business or established businesses that lack the required assets to cover the full amount of the primary loan that they need. So decisions for approval are based on the business credit history, which is, it needs to be about a 680 plus currently, although a business owner's personal credit can be taken into account if the business credit has not yet been established, i.e. for a startup. You need to have consistent verifiable cash flow, and you need to have a low 5 bank rating. The low 5 bank rating generally kills a lot of businesses and actually gets them denied because you need to have at least $10,000 in your business bank account maintained, no less than $10,000 maintained over a period of 90 days to achieve the low 5 bank rating. And then you have to have maintained that for a cycle in the majority of cases. Used to, it was just get the low 5 bank rating and you were good to go. But now you have to get it and maintain it for an additional 90 days. So that's 6 months of maintaining no less than $10,000 in your business bank account. And that, like I said, that kind of kills a lot of deals with most businesses. So you also need to have responsible bank account money management, which means you can't have any insufficient funds or bounce checks or anything along those lines. Now, business plans are usually only required for startups. Now, due to the fact that lenders have no immediate way of recouping their losses if the loan were to default, the interest rates and fees are generally going to be higher than that of a traditional loan from a bank or financial institution, which makes these loans ideally only to be used as like a supplemental loan source, not necessarily as your primary, because it can kill the profitability of the deal for the business. Now, that brings us to the considerations. You need to set limitations on the loan cost before even applying. And the loan cost is not necessarily, it's not payment on the principal, it's payment on the interest and the fees alone. So having complete transparency of those fees with whatever lending company that you're going to be going through is very important. And then having these limitations set in place prior to ever applying those is infinitely more important. It allows you to make a very educated decision. So this helps you to immediately determine if a specific loan cost is a good option for your business's profitability. Now, the way that you do that is you're going to sit down and you're going to determine exactly how much you need for the loan. Once you have that amount, then you determine exactly what you would do with it. And then on the back end, you estimate how much profit your business would make off of or as a direct result of that loan. Now, we're not talking about anything outside of that. You estimate the potential profit as a direct result of the loan. And once you have that number, be realistic with that number and then be conservative. Now, the conservative part is you cut that profit potential in half. So first, as you're going through it, you're realistic with the profitability and your estimation. And then you're conservative by cutting that number in half. And then you take 30% of half the potential profit as a direct result of the loan. And if the total loan cost and fees and interest is more than the 30% of half the profit potential, then you need to consider different funding options because we strongly believe that you can get better terms than that. All right, so next we wanted to discuss the ideal scenario. We receive a lot of questions about whether a specific loan or line of credit is the right financing decision for a business and whether there would be other alternatives that would have better terms. Now, the answer to that question is difficult to predict given the variables on both the businesses and the lender's side. So we would like to propose a better question, which is what we feel business owners should be asking. And that's, how do I find the best loans or lines of credit with the best terms for my exact financial situation? Now, I know this may seem obvious, but if you've spent any time researching up to this point, then you know how vague financing companies can be when they are trying to get you to apply for a loan. And the reason is they don't want to deter you from applying. Lenders and financial advisors have quotas to meet, and the criteria is sometimes a little bit more lenient than, say other times of the month. So if they put hard criteria down on their application or their website, then they could lose the chance of you applying in the first place. And that leads to businesses applying to loans that they're not qualified for or wouldn't be a good option for their business, and then they're denied without much explanation as to why. So the solution to the problem is knowing your business's fundability from the start, and then understanding how it coincides with the specific lending criteria prior to applying for any loans or lines of credit. Now, this allows you to make the necessary adjustments to ensure that you're approved prior to ever applying. So we strongly recommend that you acquire your business fundability score. And you can do that by taking a short test that's available through our website at bngloans.com. And this is a no-cost test, and it's a lot like looking at the exam the day before you have to take it, so you know exactly what you need to study. Now, this isn't like a test in the true sense of the word or something that you have to study for, but we call it a test because it's a rating or a scoring of your business, if you will. And the study part comes when you're fixing any of the problems prior to needing to pass the lender's test when you actually apply for a loan or line of credit. Now, what the test does is it provides invaluable insight into your business's financial foundation. And it's going to allow you to see exactly what loans or lines of credit that you're pre-qualified for right now. And it does this all without creating an inquiry on your credit report. So if you were to go off and apply to a bunch of loans and lines of credit, that creates an inquiry on your credit report. And if you consistently do that, then it's a negative impact. So the unique advantage here is that you're going to see your business from a lender's perspective. And you're going to know if there's anything that should be corrected prior to ever applying for a loan or line of credit. Now, this creates the potential for that ideal scenario of having multiple funding options available to you where you can pick the best terms for your business's circumstance. And it's going to help you determine exactly how to achieve that scenario. But it all starts with the business fundability test, which you can access the test below the video. It's only going to take you about 10 minutes of your time, and it provides an extremely valuable resource for you getting the funding that you need. Now, we know your time is valuable, so we promise not to waste it. I want to thank you for watching this video, and I truly hope it has given you a great insight on your next steps to getting business funding. This is David Locher for BNG Loans, and we will see you on the inside.